Dear friends and investors, welcome. Well, it's reform time. As you all know, Prime Minister Modi, during his Independence Day speech on 15th August, alluded that it was time to unleash second generation of reforms in India. And well, in quick succession, we have seen the unleashing of probably one of the most consequential reforms on GST. As you all know, the One Nation, One Tax or GST was implemented in 2017. And it's been 8 years, and it was perhaps time to look at the learnings and unleash reforms in GST, or as was earlier called indirect taxes. And what were the objectives of enacting these reforms in GST 2.0? There were essentially 4 pillars. One is structural reforms, which means to correct any inconsistencies or an inverted duty structure. And what I mean by inverted duty structure is that the manufacturers or producers of products or services were not able to effectively set off the GST that they paid on their inputs against the GST on the final goods or services that they delivered, resolving issues like classification across various product and service categories, and more importantly, bringing stability and predictability to tax laws, something that is extremely important for businesses and consumers alike. The second objective was to rationalize the rates. As you know, we had a plethora of GST rates, almost 4 slabs of rates, and the idea was to not only rationalize the number of slabs, but to also reduce the rate of taxes for items of common consumption, aspirational goods, and so on and so forth. Third is to simplify various processes for businesses like registration, returns, and refunds. And last and the most important was to enhance the ease of living. And as they say, this GST has delivered on roti, kapda, motor gadi, and makan. The breadth of reduction and rationalization almost touches every aspect of the consumer's life. So let's come to some numbers. The most important rejig of the GST reforms has been the reduction in the number of slabs from 4 to 3. Earlier, we had slabs which were 5%, 12%, 18%, and 28%, and then there were some items where there was a cess on top of the GST rate. We now have simplified this to a simple 3 slabs. There's 5%, there is 18%, and then for luxury goods or sin goods, it is at 40%. And as a result of this simplification and reduction in tax rates, it is estimated that the household savings as a result of reduction of taxes will be almost to the extent of 48,000 crores annually. So friends, it's not just about the one-time savings of 48,000 crores. There is a concept of economics which is called the multiplier effect. Savings leads to higher consumption leads to higher production in turn leads to higher incomes, and that higher incomes again leads to higher consumption. So there is a virtuous cycle which is set in place, and various economists have predicted that the multiplier effect of this could be anywhere in the range of 1.8 to 2 times. We believe that as per one estimate, the net benefit to the economy could be as high as 87,000 crores. As you know that the GST rates have been rationalized on consumption of daily use items or mass consumption items. We believe that this should actually lead to premiumization at the bottom of the pyramid. And what I mean by that is that when items of daily consumption get cheaper, what we have seen is that you may not necessarily buy more of the daily item, but what you may do is you may buy a better or a more premium product, or you might upgrade your purchases. We believe that this has significant benefits both for the consumer as well as to the producer. We believe that this should drive consumption moving from unbranded to branded and from entry level to more mid-tier or premium goods. It will certainly help to expand the formal sector footprint, reduce the informal economy, and improve tax compliance. Secondly, as consumers save more, they also tend to spend towards more discretionary goods, or for example consumer durables, two-wheelers, small cars, apparels, electronics, leisure. Basically, you use your savings and purchasing power to spend on more discretionary goods rather than on staples and essentials. Finally, we believe that the combination of good monsoons, lower interest rates, lower direct taxes during the budget, and now lower GST rates should fuel a very strong revival in consumption going into the festive season. If we were to really look at which are the sectors which will really benefit from the rationalization and reduction of GST rates, I think the number one sector is automotives. We've seen that the GST on small cars has been reduced from 28 to 18%. On SUVs, which were in the range of 43 to 50%, has now been brought down to 40%. Tractors from 12 to 5%. Electric vehicles remain the same at 5%. And three-wheelers, commercial vehicles, and several auto components that go into the automotives has also been reduced from 28 to 18%. And therefore, we believe that there should be a significant reduction in the price of two-wheelers, commercial vehicles, and small cars across the board. And this, we believe, is very beneficial to the automotive industry. It is important to note here that auto plus auto components forms a substantially large part of the manufacturing footprint in India, and this should really help to enhance the manufacturing activity in the country. It's also significant to note that both auto as well as auto components form over 40% of India's manufacturing activity, and hence this should significantly stimulate the growth of manufacturing in the country. Also, this sector constitutes a very significant 7+% of the NSE 500 market cap. The second largest sector or the second largest beneficiary is likely to be the consumer staples, or as is popular known as the FMCG sector. We have seen that a slew of packaged foods has seen a rate reduction from 18 to 5%, fruit juices from 12 to 5%, and a lot of items of personal care from 18 to 5%, and cigarettes has moved from 28 to 40%. The FMCG sector is also likely to see significant revival in volume growth, and as I mentioned earlier, we could see a lot of premiumization happening at the bottom of the pyramid. This sector comes second after automotive with a weight of almost 6+% in the NSE 500. After that is the insurance sector, and this is very beneficial to people who want to buy both life as well as health policies, and the government has completely exempted the GST on buying insurance policies. This should help to improve the penetration of insurance in the basket of financial services that the consumer spends on. And there is almost a 3% weight of the insurance companies in the NSE 500 index. Coming to Makan, cement GST has been reduced from 28 to 18%, and this forms 2.4% of the NSE 500 market cap, and followed immediately by the consumer durable sectors. So things like air conditioners, TVs, and it should also be positive for the electronic manufacturing services sector, which makes the components that goes into the consumer durable sector. For the farm sector, other than tractors that I mentioned earlier, fertilizers have also seen a reduction in duties from 18 to 5%, and hotels for rooms which are 7,500 and below have seen a reduction from 12 to 5% in order to boost travel and leisure spending. And finally, for items of footwear and apparel have also seen rationalization from 12 and 18% down to 5%. And these sectors also have a reasonable representation in the NSE 500 index. So what was the reaction in the stock markets on the announcement of the GST reforms and rate reductions? Well, initially the stock markets rallied hard, but by the end of the day, the markets corrected and almost ended marginally positive to flat. Many of you and many investors would be wondering, well, if this is such a big reform, why haven't the markets rallied hard? The reason is very simple. If you look at the performance of many of the sectors which are large beneficiaries of the GST rate reductions from August 15th, when the announcement was made by the Prime Minister, till the date of when the actual details of the rate reductions happened in early September, you will see that the Nifty Auto Index has already rallied approximately 8%. The Consumer Durable Index has rallied approximately 6%. The BSE Discretionary Consumer Index was up 5.5%. The Nifty FMCG Index was up approximately 4.5% as compared to the Nifty and the Nifty 500, which were almost flattish at less than 1%. What I mean to say is that the markets had already moved and anticipated the rate reductions, and we've already seen a significant outperformance by some of these sectors while the Nifty has remained relatively flattish. And therefore, we believe that the first level of discounting of the good news had already happened. Markets will now wait for the actual pickup in growth and earnings, which should be visible more from quarter 3 and quarter 4 of this financial year. Dear friends, I think beyond the numbers and the short-term beneficial impact of the GST cut and rationalization and reforms is a very important signal that the government is trying to deliver, and which is that they are proactive and are willing to counter any adverse impact that the economy may see as a result of the trade and tariff policies of the Trump government. We believe that this is the first of the many series of reforms that we will witness over the next few months and quarters. We will talk about them in our future series. Till then, thank you. Bye-bye.